Within just 30 hours of the most severe silver collapse since 1980, more than $4 trillion flowed back into precious metals. While prices on trading screens were plunging, physical inventories continued to experience net withdrawals. Premiums showed no sign of compression, and large institutions were quietly accumulating positions. When silver collapsed, then, were you observing a free and transparent market, or a redistribution phase obscured by volatility? And where, within this framework, is China positioning itself? In the immediate aftermath of the silver crash, the dominant sensation, if one stood before the screens, was not panic, but an unsettling stillness. Prices fell at such speed that charts appeared unable to register the movement coherently, with familiar technical thresholds being breached in rapid succession. What troubled experienced observers, however, was not the magnitude of the decline itself, but the manner in which the market appeared to operate with excessive smoothness and mechanical precision, as though a pre-configured sequence had been set in motion. In moments like these, the central question is not how far prices have fallen, but rather which participants are being compelled to act at that precise moment. When attention is shifted away from price charts and toward the market's physical reality, the picture changes materially. Despite the sharp decline in paper prices, physical flows did not reverse in kind. Metal did not rush back into storage facilities at a pace consistent with panic liquidation. Premiums at numerous points of transaction failed to collapse, contrary to what conventional oversupply logic would predict. This dislocation establishes a powerful real-world anchor. Two temporal regimes are operating simultaneously, and they are structurally out of sync. Paper markets, where silver and gold exist primarily as futures contracts, ETFs, and leveraged financial exposures, respond almost instantaneously to shifts in monetary conditions. A marginal adjustment in interest rate expectations or a disturbance in bond markets can transmit liquidity stress across the system within hours. Physical markets, by contrast, move on a far slower timeline. Metal is acquired for storage, for industrial use, and for long-term preservation of purchasing power. Such decisions are neither made within minutes nor reversed in response to a single volatile session. Accordingly, what unfolded during the crash was not a collective reassessment of intrinsic value, but a forced redistribution concentrated within the paper market. Leveraged positions, particularly those accumulated during the preceding phase of rapid price appreciation, became structurally vulnerable. When a policy-related shock emerged, even if insufficient on its own to justify the depth of the decline, it nonetheless proved adequate to trigger cascading margin calls. Price declines activated stop-loss orders. Stop losses produced forced selling. Forced selling, in turn, generated a self-reinforcing downward spiral. This is a well-documented technical mechanism that has recurred across multiple commodity and financial cycles. Within this environment, the role of the US dollar becomes unmistakably clear. As the system's primary settlement unit, the dollar consistently functions as a liquidity magnet during periods of stress. When yields fluctuate, capital reverses, and the demand for cash intensifies, assets that can be converted into dollars with minimal friction are liquidated first. Paradoxically, paper gold and silver fall into this category. This phenomenon does not undermine their long-term defensive characteristics. Rather, it reflects the structural hierarchy of liquidity within the financial system. The critical inflection point emerges after the phase of forced selling subsides. Contrary to expectations of demand exhaustion, the market does not enter a vacuum. A substantial portion of value reasserts itself within a remarkably short time frame. Recoveries of this speed cannot plausibly be attributed to the fragmented and reactive behavior of retail participants. They imply the presence of actors with patience, scale, and the capacity to operate independently of panic-driven market rhythms. It is here that the channel's analytical perspective diverges from conventional narratives. The objective is not to identify a price bottom, but to observe the transfer of ownership. When participants compelled to sell are forced out, assets do not vanish, they change hands. Financial history repeatedly demonstrates that such ownership transfers often form the structural foundation of subsequent cycles, regardless of whether those cycles unfold rapidly or over extended horizons. This tension becomes more pronounced when viewed against the broader monetary and geopolitical landscape. In official policy communications, China has consistently emphasized gold's role in reinforcing financial resilience and monetary stability. This stance is not episodic, but the continuation of a strategic logic spanning decades. In prolonged monetary competition, states gravitate toward assets devoid of counterparty risk. Historically, gold has occupied a central position within that framework. Equally notable is the persistent divergence between officially reported accumulation figures and estimates derived from trade, import, and production data. While insufficient to support definitive conclusions, the discrepancy is large enough to raise legitimate academic questions regarding the completeness of short-term disclosures. Monetary history suggests that significant shifts in pricing power are rarely announced abruptly. They tend to unfold quietly before becoming visible externally. In parallel, the United States is recalibrating its own approach to strategic metals, including silver. As stockpiling initiatives and supply chain security gain prominence, the implicit message is clear. Metals are no longer regarded solely as tradable commodities, but as components of economic security. When both systemic poles prioritize physical assets while paper markets continue to dictate short-term pricing, friction between these mechanisms becomes unavoidable. Silver occupies a uniquely sensitive position within this framework, due to its dual character. It functions simultaneously as a defensive monetary asset and as a critical industrial input, deeply embedded in renewable energy, electronics, and advanced technology sectors. Demand from these industries is governed not by intraday price movements, but by long-term production and capital investment planning. When prices decline sharply over compressed time horizons, producers do not wait. They secure supply. This behavior generates a form of physical support that paper markets cannot immediately register. From an analytical standpoint, the emphasis here is not on forecasting price trajectories, but on clarifying the structural dynamics at work. This includes examining the dollar's role as a liquidity absorber during stress events, assessing pressure on foreign currencies when interest rate differentials reverse, and understanding how gold and silver function as defensive assets across cycles of instability. The intent is not to guide viewers toward a predetermined conclusion, but to equip them with a framework through which to evaluate events independently. The channel's distinguishing imprint lies precisely in this approach. Rather than asking where markets are headed, it asks who is acting, and under what constraints, during each phase of volatility. When paper markets panic, physical markets maintain continuity. When the majority is absorbed by short-term turbulence, large pools of capital remain patient. This contrast does not require exaggeration. It is inherently sufficient to generate tension and sustain engagement. The value added by the analysis lies not in advice or prediction, but in enabling viewers to recognize their position within the prevailing monetary flow. As fiscal policy, monetary policy, and geopolitics increasingly intersect, understanding the mechanisms underlying volatility becomes more consequential than attempting to anticipate outcomes. It is often in moments of apparent chaos that the system's true structure reveals itself most clearly to those willing to look beyond price screens. Ultimately, the most consequential element of this episode is neither the crash nor the rebound in silver prices. It is the behavior of capital under systemic stress. This is precisely why the central question was never, where will prices go, but rather, who possesses the capacity to wait when conditions become unstable? Placed within the broader context of monetary policy, geopolitical competition, and historical precedent, gold and silver once again demonstrate their familiar role, not as instruments of short-term speculation, but as measures of trust and purchasing power over time. This suggests that the phase now unfolding may represent not a conclusion, but a transition. In the months ahead, as fiscal, monetary, and supply chain pressures continue to converge, metals markets, much like space technology or strategic infrastructure, are likely to reflect long-horizon dynamics more than session-to-session volatility. What is emerging may be the early stage of a cycle in which pricing power, rather than quoted prices alone, becomes the decisive variable. How, then, do you assess the implications of this shift for the US dollar, foreign currencies, and the role of gold and silver over the coming years? Where do you perceive the most significant opportunities, or the most substantial risks? Share your perspective, because it is through such discussions that the broader picture comes into focus. This is Money Cycles, where we examine the structures underlying volatility. If you wish to follow subsequent analysis as this narrative develops new chapters, you know where to find us. What matters most is not how violently markets have just moved, but the range of possibilities emerging as the next cycle takes shape.